Hello and welcome to our November webinar. I'm Jodi Robinson, Vice President of Tax Services, and I'm going to be moderating our session today on the One Big Beautiful Bill Act, otherwise known as OBBBA, and its impact specifically on philanthropy and estate planning. Just as an FYI, the session will be recorded and emailed out to everyone who's registered. Should be within the next week or two that you receive that. But joining me today, I am excited to have two panelists from our Mariner team who specialize in high net worth estate and charitable strategy. I have Jennifer Kohlbacher, Director, Wealth Strategy, and Scott Luhnau, Vice President, Multi-Generational Wealth Planning. Thank you both for joining me today.
Good to be here, Jodi.
Great.
Happy to be.
We do receive a lot of questions about One Big Beautiful Bill Act and how it impacts the approach to charitable and estate planning. Speaking of questions, you as an audience member can feel free to submit your questions in the Q&A box, and when we get to the end, we will try to answer as many of these as we can. Once we're done discussing, some of the questions may get answered as we go, but we'll try and answer as many as we can once we get to the end. So with that, we'll go ahead and get started. We'll kick it off with Scott. Scott, one of the big uncertainties with the tax bill was how the estate tax exemption was going to turn out. Can you share with us or talk about the result and how clients and their advisors should look at estate planning in the foreseeable future as a result?
Absolutely, Jodi. But the first thing I have to say is up until now, I thought ABBA was a musical group, but I don't know.
Should have been a lead-in song.
That's a good idea. Well, I mean, the tax bill was a big relief from an estate planning standpoint. For years, we had been dealing with uncertainty, and then it would be like fits and starts. Everybody would be scrambling to do planning, and then some changes would come or they wouldn't come. But now we finally have a little bit more certainty. And the good news is that the majority of clients do not need to worry about the estate tax currently, right? Now, when a new administration comes in, who knows what's going to happen, but we have certainty for at least another 3 or 4 years, which is great. And up until now, also, we've really been driven largely by the estate tax and minimizing it or reducing it, right? When we're dealing with clients, it's how can I pay less estate tax? How can I pay no estate tax? And the really nice thing now is that we can focus more on these substantive thoughts and goals behind planning in general. And what I mean by that is instead of being driven by the estate tax, now we're really focusing with clients more on, would you like to do lifetime gifting? What kind of legacy do you want to leave? Do you want to be philanthropic in some way or another, right? We're really able to roll up our sleeves and do more substantive planning that really focuses more on goals rather than a tax outcome, right? So to get more specific, the estate tax exemption is going to go to $15 million per person on January 1st. So just in a month and a half or so. If you're single, you have a $15 million exemption. If you're married, you've got a $30 million exemption, right? So the way that we at Mariner are looking at this, we're compartmentalizing it into 3 groups. And the first group is those clients that have a net worth of less than $10 million. And again, the good news there is no immediate action is required, right? Because you're a long ways off from being exposed to estate taxes. So what we want to do is make sure that those clients have a really good, solid, standard plan in place. And if you're a married couple, we call that a standard A-B estate plan, where there's A-B planning at the first death, right? That A-B refers to what we call the credit shelter and marital trusts, right? That ensures that there's no estate tax at the first death. And then we want to talk to you about whether your children should receive their inheritance outright or in trust, right? So we want to make sure that you have a really solid basic estate plan in place. And also we want to make sure that you're really thoughtful about fiduciary selection. In other words, who are you selecting as your executor and your trustee? Right, we want to make sure that those choices are all really good. So that's the below $10 million range. The next category is between $10 million and $30 million. And this is really sort of our highest planning opportunity, right? If you haven't done so already, what we encourage you to do is have your wealth advisor do some projections for you to show you if your estate grows at this rate, what will your net worth be in 10 years, 15 years, or maybe even 20 years? You may not have a taxable estate now, but the power of compounding is so strong that you could have a taxable estate in 10 years from now. And who knows what the tax laws will be. So if there are any strategic moves that we can make, maybe it's because you own certain assets, ones that are likely to highly appreciate, right? Maybe if you want to look at philanthropy, maybe there's things that we can do now to make sure you either never have an estate tax issue, or if you do have one, it's significantly minimized. But the key is if you don't act now, you really lose out on those opportunities. The other thing that we want to look at in this $10 to $30 million range is asset protection. To what extent can you or should you look at protecting your assets from liabilities, creditors, predators, right? Those kinds of things, lawsuits. We definitely want to focus on charitable planning, right? Are there any charitable planning advanced strategies that you can implement to get large charitable deductions, but also to really maybe involve your family in charitable planning? And then last but not least, one thing I'm seeing a lot of right now is Roth conversions, right? And what a lot of clients are doing is they're actually combining Roth conversions with charitable strategies, right? Because when you do a Roth conversion, you're triggering income tax. But if you also do some significant charitable planning at the same time, you can significantly offset the tax that's going to come along with Roth conversions. So that's really the $10 to $30 million range. And then the above $30 million range, I'm sorry, but you guys have estate tax exposure still, and it's business as usual, right? We want to work with you on determining what your appetite is for, number one, paying estate taxes, and number two, what your appetite is for complexity, right? Because we don't want to implement anything that's going to cause you stress or anxiety. We want to do things that you can handle and manage going forward, right? Whatever those structures might be. We want to look at lifetime gifting, whether it makes sense to get some assets out of your estate now rather than later. And who are the recipients of those gifts? Are those your kids? Is that maybe planning for your spouse, right? This is where we get into our wonderful acronyms that we love in estate planning, like SLATs, Spousal Lifetime Access Trust, right? If you have estate tax exposure, the tried and true technique of life insurance trust is still very, very applicable to you, right? So we would definitely want to look at all of those things. And again, it's business as usual. You've got a taxable estate, and we want to help you minimize that. I know that was a lot, Jodi, but that's sort of the introduction to the estate tax part of this.
No, but I think that's perfect. And one of the things that we continually talk about at Mariner is just the fact that even if you're in that $0 to $10 million range, the importance is still on getting the basic, the basic blocking and tackling done, like you mentioned. Don't go, whew, I'm out of the weed, I'm in the clear. There are still things that need to be done, for the benefit of your estate and your beneficiaries.
Exactly.
Scott, another thing that one big beautiful bill did was preserve portability of exclusion amounts. And I think there's sometimes confusion around portability and what that means. Can you talk a little bit about what that is and how clients should be thinking about it?
Sure. So do you remember the below $10 million range that I talked about first? Um, One of the key things there to having that standard estate plan in place is to make sure that it has flexibility built into it. I would say before all of this controversy with estate taxes, estate plans were a lot more rigid. it was, very, very binary. It's black and white. When you die, this happens, and these trusts are created. And what we really want to see now is more flexibility. And I like to call that post-mortem estate planning. In other words, if one spouse dies, it's not written in stone what's going to happen. There's some flexibility to go this direction or that direction, right? And one of those concepts that we want to take into account is portability. So again, if you're married, each spouse has that $15 million exemption. And the question is, when the first spouse dies, should that exemption go into what's traditionally known as a credit shelter trust? Or should that exemption be ported, transferred, given to the surviving spouse? So instead of having a $15 million exemption, the surviving spouse could actually have a $30 million exemption just for themselves by porting or transferring their deceased spouse's exemption to themselves. And this flexibility planning allows that choice to either do that or not do that. So that's definitely something that we want to see in your estate plan, is that flexibility. And if you have any questions whether your plan has that or not, just reach out to your wealth advisor and we can take a look at that for you.
Yeah, and I think it's important to note that portability doesn't just happen, right? You have to take action to do that once the first spouse passes. So it's not just a freebie. There's a proactive action that has to take place.
Definitely.
Um, so with the higher exclusion amounts, you mentioned that many clients may no longer need certain tax-driven structures, like credit shelter trusts. So what should estate plans for married couples look like going forward?
Yeah, so this is actually directly related to the question you just asked me, Jodi. And so I can't help it. I'm an estate planning attorney, so I'm kind of a nerd when it comes to these kinds of things. Can't help it. So I'm gonna get a little bit technical on you with this next answer. Um, Traditionally, when we had the more rigid estate plans, it created that A-B planning, and the B trust is what's known as the bypass or the credit shelter trust. And its purpose was to receive the estate tax exemption of the first spouse to die. So the estate plan would say, when I die, I give the largest amount that can pass free of estate tax to a credit shelter trust, right? So that's you giving your exemption to this credit shelter trust, which has a lot of benefits. But because of the large exemption now, we want there to be more flexibility. So what we want to see is that instead of everything going to the B trust, we want everything going to the A trust, which is the marital trust, right? So what the formula will now say is, when I die, I give all of the residue of my estate to the marital trust. However, if my spouse disclaims any or all of the assets that are headed towards the marital trust, then those disclaimed assets would be going to the credit shelter trust. So what's a disclaimer? Most people think that if you are left an inheritance by somebody, you have to take it. You actually don't. Now, why would you not accept an inheritance, right? But still, you could put your hand up and say, nope, I'm not going to accept that. I refuse to accept that inheritance. So that's essentially what a disclaimer is a strategic move by the surviving spouse to say, you know what, because of the tax laws in effect right now and because of my financial situation, I'm going to exercise this disclaimer right. This is why you want to have this solid team of financial professionals surrounding you so that you can get that advice. Should I do this? Should I not do this? To what extent should I do it? But again, this is a very specific example of this flexibility that we want to see in estate plans for married couples.
Yeah, I mean, those are all great points. And then one last question for you, Scott, before we transition over to fully engage in charitable discussion with Jennifer. So ABBA being one big beautiful bill does have a number of provisions concerning charitable. How does that, I guess, what does the charitable planning landscape look like from an estate planning standpoint, just so that we can address that too?
Well, this is where you really want to be strategic when it comes to certain assets that you own, right? I'll give you two examples. Right now, we're actually working with a lot of clients who have very large concentrations of appreciated stock. So a lot of these clients, work in the tech industry and they have these, technology stocks, which, their names. And of course, they don't want to sell them because that would trigger a huge capital gain, right? This is where we want to look at charitable giving strategies like donor advised funds or charitable remainder trusts, charitable lead trusts to get two birds with one stone. Number one is to diversify that asset and to pay no capital gain, but also at the same time to implement maybe some charitable giving strategies, right? So charitable giving is not something that you just do at death. You can do some really positive, powerful things during life and get some really nice tax benefits from it. So appreciated stock is one thing. Um, Real estate, if you have some real estate that you've owned for 20, 30 years and you just don't want to sell it because there's a huge gain, or we're working also with a lot of business owners, right? This is where we want to do what's called pre-sale planning with the business owner. Before you sell your business, let's do some strategic planning that can give you some charitable benefits, but also have you pay a lot less tax when you sell that business. So it really comes down to the assets that you have and to what extent you're charitably inclined, Jodi.
Yeah, thank you for that. And I appreciate your point. Excuse me, my lights got out here. I appreciate your point that you mentioned that you don't have to do your charitable giving after death, that you can also do some pretty impactful things during your lifetime and see it perhaps, play out. Which is a nice segue to Jennifer and talking a little bit more about the charitable specific provisions in one big beautiful bill. And in IRS fashion, they didn't throw us just one nugget, they threw us a bunch. Can you kind of talk through what that includes?
Absolutely, Jody, and you're right. They did throw us multiple, and I think some of them kind of surprised us. We had seen some of the draft legislation going through, but there were a few surprises. But overall, several of them were really positive. I'm going to start with one of the positive changes. Back in 2017, when the Tax Cut and Jobs Act passed. What it did is we had a limitation when you gave cash contributions to deduct up to 50% of your adjusted gross income. When that Tax Cut and Jobs Act was passed, so back until 2018 to this year, we were able to deduct up to 60% of our adjusted gross income. That 60% was supposed to sunset and revert back to 50% starting in 2026 next year. When the legislation passed, that was one of the things that they made permanent. Now I'm going to go back to Scott's comment earlier. Permanent basically just means until new legislation is passed, probably within a new administration, but at least for the next 3 or 4 years, we know that that 60% is still in place. It is there for cash donations. And so if Scott mentioned some stock donations, some other donations, which we're going to talk about in a little bit, the 30% of adjusted gross income and 20% of adjusted gross income for donating cash securities, non-cash assets to private foundations, those stayed in place, but for cash gifts, that 60% AGI is carrying forward, which is, I think, really, really powerful.
Mhm.
Another thing that kind of came back, which was great, during the COVID era, we saw this above the line deduction. I don't know if many of you remember it, that $300 or $600 for either if you're single or married, that whether or not you itemized your deduction, if you gave cash contributions to public charities, you got that immediate deduction above the line. That was just around for those few years to really spur, that charitable impact and impact our communities. Well, it came back under the new legislation. So starting next year, we'll get it, but it bumped up. So for singles, you'll get $1,000 above the line deduction. For married couples, you can get up to $2,000. Now it is a cash contribution. So non-cash donations don't get that above the line. And it does need to go to a public charity, but that's really, really powerful because with the standard deduction, this year in 2025, it's 31,500 for a married couple. And so we are only seeing about 10% of households actually utilizing itemized deductions on their tax returns. So what that means are, the vast majority of individuals that are making charitable contributions to support their community are not getting the tax benefit for those deductions. And so what this above the line deduction it allows you to get the benefit, up to the 1,000 or 2,000 for the cash donations you're making on top of taking the standard deduction that you're taking. So that was another really positive thing that passed. Pro tip on that, save your receipts for those 1,000 or 2,000 for those cash contributions. So you have them in your file, forward them to your CPA, just save them if you ever need it. That's what we need to substantiate the gift. Then we had a few surprises that hit us. One of the surprises is actually something new, but starting next year in 2026, there is a new limitation on charitable contributions if you itemize and take the deduction there. There is what's called a 0.5% floor. And so what that essentially means, and we'll get into in depth in this, is when you make a charitable contribution in 2026 and you itemize your deductions, the first 0.5% of that contribution is no longer going to be deductible. We'll get into examples and some, in a little bit, but just know that that is out there because that was a bit of a surprise that hit us, that there's going to be that limitation. Mm-hmm. The last thing that I'll mention for the legislation that passed is for those taxpayers that are in the highest tax bracket, that 37% tax bracket, on top of that 5% floor limitation that's for everybody, those in the highest tax bracket are going to have a little bit of a haircut on their itemized deductions. And so essentially what that means is if you are giving and making a charitable contribution and you're in that 37% federal bracket, the benefit that you and I or any taxpayers would get today is a 37% deduction, on that. And so we get the benefit. Essentially, that's being reduced to about 35%. So we're losing that little bit of that 2%, but it's on all of the itemized deductions. And we'll get into an example in a little bit. So a couple great positive things, a few surprises, and a few things that gave us some things to plan around, which is exciting.
It is exciting, but it's also a head scratcher because sometimes you're like, why are they trying to like discourage charitable contributions? I don't think that's the overriding intention. Purely, some of these were revenue generators when they were going back through and figuring out how to meet the budget piece of it. So, so you talked about the AGI, the 0.5% floor. I think we get a number of questions about that, what that means, what's that going to look like. Can you talk a little bit more about that and maybe give an example of how that would work?
Yeah, so essentially the floor reduces like I said, reduces your charitable contributions for the first 0.5%, and it's based upon your adjusted gross income. So for example, if a married couple had an adjusted gross income of $200,000, and let's say that they were going to make charitable contributions of $10,000 in between their state and local tax deductions, their mortgage interest expense, the $10,000 charitable, they're going to itemize. Well, that 0.5% is based upon their adjusted gross income of $200,000. So essentially, their first $1,000 of the $10,000 charitable deduction is not deductible. So we're only getting to deduct $9,000 instead of the $10,000. And so obviously the higher your adjusted gross income, that threshold's a little higher, but it just reduces your deduction. So a $10,000 deduction in 2025, in 2026, that same deduction, you're getting a $9,000 deduction. So it's that little haircut. That applies, again, based upon your adjusted gross income if you're itemizing your deductions.
And I think it's also worth pointing out that that also applies to like carryover contributions coming from 2025 into 2026.
It does. So if you make charitable contributions, and we talked about that adjusted gross income limitation on there of 60% for cash donations, 30% if you're giving appreciated securities. If you have charitable contributions in excess of that, the IRS says, no, you don't lose those. You can carry those forward. You can carry them forward up to 5 years. But since we're carrying them forward from 2025 to 2026, that 5% threshold does apply to our carry forwards as well. And so it's just something to be mindful and plan around as we're working on kind of tax projections and everything. But it does apply to that carryover as well.
Yeah, for sure. Want to certainly be mindful of it. So you mentioned the 35% cap on itemized deductions. I'm big on examples and like how does this play out using real numbers? Could you maybe walk through an example of what that 35% cap on itemized deductions would look like in a scenario?
Absolutely. And I don't know where and how tax legislation came up with some of these rules. I was in a round table with a number of attorneys and CPAs the other day, and I think the key takeaway was everybody use your software because there's a lot of complexity that got introduced starting in 2026. But essentially, there is going to be what they call a 2/37 reduction of your total itemized deductions. So it is the state and local tax deductions, it is the mortgage interest, the investment interest that's there, and the charitable contributions. If you are in that highest tax bracket, you do get that limitation. So an example of if your adjusted gross income, let's say, was $1 million, and you made a charitable gift of $10,000, you did that in 2025. If you're at that 37%, you essentially get a tax benefit of $3,700. 37% of your 10,000 that you gave. 2026, that same deduction, because of your $1 million adjusted gross income, you've got that 5% AGI floor now that we've got to get over. So the first 5,000 isn't deductible just from that because you're $1 million AGI. And then you've got that 2/37 cap, which is another piece. So instead of $3,700 benefit for that $10,000 donation, you're getting a $1,750 benefit from that. And obviously the higher the adjusted gross income, the little bit of more of a haircut you get. And a reminder too, this just does apply if you're in that 37% tax bracket. And so I know we're gonna jump into some planning opportunities, which is what I'm most excited about. But this is just a key area that makes planning more impactful and more important because bumping into that 37% bracket, obviously there's a lot of tax consequences. Now we have even more with this reduction on all of your itemized deductions.
Yeah, so when we are talking about planning with our clients, when our clients are thinking about their own planning, what are some strategic considerations they should be, what should they be thinking about right now?
Yeah, and it's actually the perfect time of year to start having this conversation. We're having a lot of these conversations with our client, but the key is timing matters. because we're getting ready to have, this new legislation come into play, impact 2026 gifting. And so one of the things that may make sense is consider doing more charitable giving in 2025 than in 2026. As you look at kind of the bigger picture over the next few years and look at what some of those charitable goals are, it may make sense to front load some of that. Scott mentioned something that I think is key earlier, a donor advised fund. That could be a really powerful tool, especially going into the changes. And so, what a donor advised fund is, and most custodians have these, they're pretty simple to open, but they can be really powerful, is it is a charitable fund, so it's a tax exempt account that you can donate into. You get a tax deduction the year you donate. You're able to put cash in there. You can put securities in there. Scott mentioned some business sale pre-liquidation planning. There's some unique things you can do with the donor advised fund, but you can contribute that. You get a deduction the year you put it in. That donor advised fund can be invested, the assets can grow, and you can have those funds go out to public charities over time as you wish. There's no requirement that they go out at a certain time. So, Jodi, as I'm thinking through, like an example, is if I knew over the next, 3 years, I was going to give $40,000 to charity over the next 3 years, instead of doing a little bit each year where I'm going to be applied that 5% haircut each year, I may want to go ahead and make that in 2025. Maybe have some appreciated securities that I could do, put that in the donor advised fund. I get a deduction in 2025. Those haircuts don't apply. Those funds can be invested. I can dole them out to charity over the next 3 years, still meet my goal, but I essentially got rid of that haircut, which can be really, really impactful. Um, so a great tool. The other thing I would say is intentional charitable giving can be really, really powerful. Yes, this new legislation came in, and Scott also mentioned this earlier. Having the charitable plan be part of the larger financial plan, your estate planning, your cash flow planning, and your tax planning, all coming together can really be the most impactful over a period of years. Because when I'm looking at tax just in a vacuum, and let's say, Jodi, it might make sense from a tax perspective for me to give more in 2025 because I don't have that haircut. But what if in 2026 I'm selling a business or recognizing a deferred comp or some liquidity event is happening that's making my tax bracket be a lot higher in 2026? Even with the haircut, strategically, if I look over a period of 3, 5 years, I might be better off doing it in 2026. And maybe there's some other tools and charitable trusts that, kind of minimize what that haircut looks like, but overall I'm saving more tax. And so timing matters, intention matters. And so let's look at it in a bigger picture and just see what makes the most sense. Like have the conversation. The other thing I will say is if you are looking at doing a bigger contribution in 2025 because of the haircut, I actually had a conversation earlier this week with a family that is looking at doing a fairly large contribution in 2025 for a specific reason because they have a specific charity that's near and dear to the family's heart that they wanted to honor a family member with. Their income level is not high enough where we could take advantage of the deduction in 2025. And we looked at the 5-year carryover rule. It'd be hard to use it then. But they have a really, really large IRA. And so what we're doing, we had their estate planning conversation, we had their financial planning conversation. They have this big wish to give the donation this year. And so we're pairing that with a Roth conversion. And so we're going to take their large IRA and we're going to roll some over to a Roth. It'll increase our income in 2025. We're going to get the benefit of the charitable deduction. And now we've also got a Roth IRA, which is going to be extremely powerful both in their estate planning, their long-term tax planning, and their overall goals and wishes and the legacy that they wanted to leave. And so being really, really intentional with how we're doing things can really be powerful.
Yeah, absolutely. And we're not saying don't do charitable contributions after 2025, right? I mean, you said there's still plenty of planning to be done around it, but just know that there is, perhaps some time sensitivity to take full advantage of the laws as they are here in 2025 as we close out. So, QCDs, qualified charitable distributions from IRAs, have always been an important part of planning for taxpayers and who may not need their full RMD for cash flow purposes, who want to do something charitable with it. OBBBA makes those, I think, even more valuable and more strategic. Can you talk a little bit about how that might work?
Absolutely, yeah. Qualified charitable distributions are really powerful and is available for those individuals that are age 70 and a half or older. So if you have an IRA and you are 70 and a half, you are actually able to make your charitable contributions straight from your IRA to the charity. This year, your each individual person can do up to $108,000. For years, that number was 100,000, stayed at 100,000, and then we saw it get increased. So this year in 2025, it's 108. Next year, it'll bump up a little bit more. But that's powerful for a number of reasons. One of them we talked about, that 5% haircut. Well, that 5% haircut only applies to itemized deductions. So if you have charitable contributions going straight from your IRA, that's an above the line deduction. Up to 108,000 is not taxable. So there is no haircut on that. If you're in that highest tax bracket, you don't get that 37 to 35% haircut as well. So really, really powerful. I mentioned earlier, only about 10% of the households actually use the itemized deductions. The qualified charitable distribution, you can make that out of your IRA. Again, it makes it not taxable. It's above the line deduction. So you can still use the standard deduction on top of that. I was working with a family the other day. They did have a fairly large IRA, and they were making charitable contributions into their community every year but they were using the standard deduction, so they weren't getting a tax benefit. And so we had a conversation, and I said, hey, you can take that same $15,000 that you're giving every year to your community. Let's just have it come straight from your IRA. And then that $15,000 is not taxable when it comes out of the IRA. And then we're taking advantage of the standard deduction. So same exact cash flow, same exact plan. We just pulled it out of their IRA instead of their checking book and saved them several $1,000s of income taxes. This is especially impactful because Medicare, Social Security, a lot of those Medicare premiums are based upon your modified adjusted gross income every year. And so if we're able to reduce that by having your charitable contribution come from your IRA, that could also impact your Medicare premiums in a positive way by reducing those. So really, really impactful. We talked about a donor advised fund, so I want to clarify a couple things. The qualified charitable distribution has to be made to a public charity. So it can't go to a private foundation, can't go to a donor advised fund. You can leave IRAs, those things, but the qualified charitable distribution does need to go to a public charity. And if you are thinking about doing that, it's important to also do that ahead of taking that RMD or that required minimum distribution. Because if you take it before you take your required minimum distribution, it helps you meet your required minimum distribution as well, which, just keeps your income lower. So really, really powerful tool.
Yeah, and we didn't get into all of the provisions of OBBBA here in this webinar, but QCD, using a QCD can really help you manage your adjusted gross income to still take advantage of a lot of those OBBBA benefits as well, with the increased SALT cap up to $40,000, the enhanced senior deduction, the vehicle loan interest, some of those other provisions as well. So really, really worth considering if that's something that you're focused on. So I would also ask if maybe both each of you could share any real life examples of what you guys are doing with clients and in conversations with advisors post one big beautiful bill. You guys are interacting continually with clients, prospects, and advisors. So what kinds of things are you seeing put into action in the real world?
Do you want to start, Scott?
Oh, sorry. Jennifer, do you want to go first?
Sure, I can go first. So Scott mentioned kind of something earlier, which is what we are seeing this a lot, and that's concentrated securities or really low basis stock. Several of our clients and families across the country thoughtfully were able to get in and invest in a lot of these stocks, or maybe even stock and had it a really long time, so the basis is really, really low. And you want to diversify, but you don't want to incur a big capital gain, and you have some charitable intent. One of the things that we can look at with families is you can actually contribute that stock into a type of charitable trust called a charitable remainder trust. There are many types of charitable trust. We won't bore you with all of them. I get really excited about them because they can be powerful. But with the charitable remainder trust, you can contribute, low basis stock into it. You get an income tax deduction for putting it in there. That charitable trust is tax exempt. And it benefits two parties. It benefits charity at the end, but during your life, you can get an income stream from it and spread out the gain. So Jodi, if I put a bunch of stock in there, I get an income tax deduction. I can take an annuity or income stream from that charitable trust for the remainder of my life, maybe a 5% stream. That, annuity payment to me is taxable, but it's a small amount every year that I'm planning. So it spread out that gain when I sold the stock and diversified it. And at the end of my life, whatever's left in that trust, and I've invested it, yes, I've taken an income stream, but I've invested it, that's going to go to a charity I want to leave a legacy and impact to. Really, really powerful tool with the concentrated securities, low basis stock as well.
Well, Jennifer, that's actually a perfect setup for what I'm going to say. And now I don't have to explain what a charitable remainder trust is. So one of the things that I'm seeing a lot of activity on is large IRAs or 401ks, right? So this is now starting to become one of the largest assets that a lot of our clients have. It's not uncommon to see multi-million-dollar IRAs. A couple of weeks ago, I actually saw an IRA, and I'm not joking here, $43 million.
Wow.
This was almost all NVIDIA stock, that was acquired from the very outset, okay? But, these kind of things happen. But anyways, the problem is, well, first of all, let me back up. If you're married, obviously you should name your spouse as your IRA beneficiary, because then you can do a rollover, continued deferral. So where we're having the conversations is what happens to that IRA at the second death? Or if you're single, where does your IRA go? And the problem is IRAs going to non-spouses are subject to the 10-year rule. This is under the Secure Act, and it says if your IRA goes to a non-spouse, it must be fully distributed 10 years from death. Now, do you want a child or a grandchild to really get several $1,000,000 forced out to them in a 10-year period? Usually the answer is no. Now, you can leave IRAs to trusts, but you should really only leave an IRA to trust if there's a specific reason for doing so, like a beneficiary is financially immature or has drug issues or whatever. So what we are seeing now more and more is that at the second death, clients are creating charitable remainder trusts for their children and leaving the IRAs to the charitable remainder trusts. So what this allows is to basically negate the 10-year rule, because the CRT, the charitable remainder trust, will pay an income stream to the child for the rest of their life. So if they're 40 years old, they could get distributions for another 40, 45 years, right? As opposed to being forced to take the full distribution in 10 years, which also spreads out the income tax, which makes less tax paid to the IRS. So if you have large IRAs, and the rule of thumb that I use is if you have an IRA over $1 million, you definitely should consider the charitable remainder trust strategy.
And Scott, it also provides you a deduction on your estate tax too. So it can also be powerful in that way.
That's true.
Great examples. We do have some questions in the Q&A, but I do want to, before we do that, ask you guys in parting, what is an opportunity or a risk that you think is perhaps underappreciated right now? Something that even well-advised clients might miss or overlook?
Jodi, what I would say to that is becoming complacent and thinking that, you know, the tax rules are not going to change significantly again in the future, especially the estate tax. So, you know, if there are planning opportunities in your net worth statement in your family, take a look at those and see if it makes sense to do them, right? This is that lifetime proactive planning that I was talking about. So don't kick the can down the road. Don't assume things are going to stay the same. And if you've got some planning opportunities, utilize them.
Jen?
I would also say, Jodi, continuing to plan ahead and use, I guess, pull everything in, the financial plan, the cash flow plan, the estate plan, what your overall goals to accomplish with charity. Two things. It'll help us really reduce tax over the long time. Like, is it better instead of just doing cash donations throughout the year? Maybe we have stock and we make it at the beginning of the donor advised fund and then distribute it out, which can save you a lot of taxes on the, on the back end instead of just doing cash. And then secondly, if it is part of your big plan overall, pull it in to make it an educational tool for your family. That's a great way to educate kids on investing, on values of the family to pass along. So, I mean, even if it's $10,000 to a donor advised fund, start using it as a teaching tool and bring it along. I mean, it's powerful.
Yeah, I mean, those are both really great points. We do have some questions in the Q&A that I'm going to throw out to you guys. We'll get through as many of these as we can. One of the first ones that came in was under the new One Big Beautiful Bill limits, with the 15 million lifetime exemption for an individual and 30 million for a couple. And have a living trust, does it make sense to create one slat and forego the step up in basis? This is a pretty sophisticated question.
Jodi, I'll take that one. And I could probably talk about this for 30 minutes, but I'll answer it this way. It depends on the assets you intend to fund the slat with. If it's, you know, a closely held asset or real estate or a business interest with a low cost basis, the cost basis step up and the loss of that is an issue. But if it's going to be marketable securities in an actively managed portfolio, capital gains are really not that much of an issue. So I would say it really depends on the type of assets you want to fund that trust with.
Perfect.
The other, I guess, piece to component to that is Scott mentioned this. The tax rate is lower on capital gains. The estate tax is a 40% rate. And there's also 12 states that have a estate tax. So that could even look higher in some states. The estate tax is due 9 months after somebody passes away. Whereas, yes, we could potentially lose a step up, but there are different investment strategies and strategies that we have that can actually help mitigate the capital gain. And most of the time, not all the time, but most of the time, you've got some control over when you sell those assets in the stock and realize the capital gain. So that's another thing to take into consideration. All of a sudden, you could have a 40% potentially plus if you're living in one of those states as a state tax that's due right away, where we can be really strategic on the timing of the capital gain and use other tools to potentially reduce it. So again, let's look at the big picture of what the assets are and other tools we have and look at the long-term goals.
We have another question that relates specifically to state of Oregon's limit for estate tax purposes. But there are, I mean, it's a great question. There are some states have different levels of estate exemption than the federal. So anything specific that you want to advise regarding those? I mean, clearly they require some planning just for that. But I'll let you, one or both of you, comment on how you would work around that.
If you live in one of those states that Jennifer just mentioned and you're married, you really, really should have in your estate plan what's known as a state-only Q-tip trust election. Now, again, I know I'm getting really technical on you, but again, this is an additional, remember I mentioned AB planning? So this is an additional trust that's created at the first death to help minimize that state-only estate tax, right? It's another trust that captures more of that exemption at the first death. Now, if you're single and you're not married, that obviously is not available to you. Then the most powerful tool in your toolbox is charitable planning strategies. And you can still leave a substantial amount of inheritance to heirs using certain charitable strategies.
Perfect. A couple of questions about donor advised fund for the $2,000 above the line. Jennifer, I think you mentioned that, but it's worth repeating.
Yeah, it does need to be for public charities. I think we have this similar question on QCDs, like why can't you give them to a private foundation? They're still 501(c)(3). Unfortunately, donor advised funds and private foundations are specifically excluded from like QCDs, kind of similar. It needs to be that public charity that falls under, the IRC, the 170B1A, basically. There's specific lists. So unfortunately, public charities.
Right. So if someone was intending to make their 2026 donation to a donor advised fund, that can't be included as part of that above the line type deduction. Let's see here. Some of these are people have asked about recording or AI notes. I know for sure the recording is going to be sent out to everybody. I don't think we're going to have AI notes, but you'll get the recording. Someone asked if QCDs from an IRA account are treated differently under the new bill. We did talk about that they do avoid that 0.5% haircut and that 35% limitation. And they also help you manage your modified adjusted gross income for a multitude of other one big beautiful bill provisions. Here's a question. If I open a donor advised fund with stock and take the deduction in 2025, do I still get credit for the additional deduction that may result from any increases in value of the donor advised fund over time?
No,
Right.
unfortunately.
I was going to say, great
Unfortunately not.
question.
That
You
would be
can
nice.
add, yeah, you can add to the donor advised over time if you want additional deductions. So if your account is growing, accounts outside the donor advised fund, you can continue to add for it. But
Jennifer, you mentioned this, but I think, again, some of these are worth repeating and just reinforcing. Someone asked, does the $108,000 QCD from an IRA qualify as an RMD for the year?
It does if you take it out before you take out your required minimum distribution. So
Fantastic point.
if you do want it to come out, again, this goes back to let's be strategic and plan. If you do want charitable contributions to come out of the IRA and use the qualified charitable distributions, we typically advise that's done first and then take the remainder as your required minimum distribution. If you've already taken your required minimum distribution out, then you can still do the QCD, but you've already taken your required minimum distribution at that point.
Great point. There's confusion over that a lot. Someone also asks, just to reinforce, the QCD is only applicable for those over 70 and a half to donate from an IRA.
Yes, that is correct. So, and an important kind of point, and it's something that we were actually looking at, is required minimum distributions right now, you don't have to take them till you're 73. And so something to look at with your advisor is, does it make sense to go ahead and start making charitable contributions out of it only from 70 and a half to 73 before the required minimum distribution, so that you get that IRA balance lower to reduce your required minimum distributions? Or does it make sense to get the net, the growth on it for the next 3 years and then do some things from there? And so we were doing some analysis. So good planning tool, but yeah, you do have to be 70 and a half and then you can start doing it.
Scott, there's one in here that I think we can probably throw to you on estate planning, and perhaps briefly touch on it. Could you touch on how to set up your plan to have a surviving spouse maintain the $30 million estate tax exemption? I think we talked a little bit about this, but if you want to reiterate.
Right. So there's really, the options are obviously to leave your estate outright to your spouse. Option number 2 is to leave it to them in a marital trust. And there are asset protection reasons for doing that possibly. And then the third option is having your exemption go to a credit shelter trust. Now, whether it's a marital trust or a credit shelter trust, your surviving spouse is still the primary beneficiary of those trusts and has access to those funds. So having those trusts is in no way taking the money away from your surviving spouse, but it does provide estate tax protection and what we call creditor and predator protection. So it really comes down to your family situation of which route makes the most sense for you.
Yeah, lots to discuss around that. Decisions can't be made in vacuums. It's all very case specific, right?
Right.
Several QCD questions. Jennifer, can a QCD go to an international public charity?
Great question. The answer is it depends on if that international charity is actually kind of qualified as a U.S. public charity. A lot of international charities can get what they call like an equivalency determination or actually apply for U.S. exemption. So in that point, it would. Otherwise, it would not. It's very similar to, I get the question a lot from donor advised funds wanting to give internationally. And it really depends on how that international charity is set up. There are some, if that's something you're passionate about, obviously talk to your wealth advisor because we've got a lot of resources around this. But there are different things called like friends of funds and U.S. charities that are partnered with a lot of international funds. So that way you can make your donation to the U.S. charity and it ultimately ends up there. So there are ways to do it. You just need to be thoughtful about it to get it to qualify.
Yeah, and you want to make sure that it does. We're closing in on the end, the top of the hour. I want to thank both Jennifer and Scott for joining me. I know we didn't get to all the questions in the Q&A. If you've got questions, please reach out to your advisor. and they'll help you get it answered, whether they can answer it themselves or they'll pull in the appropriate people. But great to have you all with us today, and hopefully you learned a few things as you go into your year-end charitable and estate planning. Thanks, everybody.